Hello and welcome to Trading the Trend. This is August 7th. I couldn't believe when I wrote August 7th. I was like, my gosh, next month is September. You know what that is, football seasons. And many of you are getting excited as we speak. Hello, Dom, Sharon, Jack, Oda, JP, and many others. Welcome to all. We have Brent Morris in the chat. We welcome him. And just real quick, you could follow us on X. My handle is at James Boyd CS. It's at Brent Morris CS as well. So make sure if you have any questions or comments, some people leave us comments there, and also reply to the post. Also, just real quick, we do post announcements on X, so make sure you check that out. Now, just real quick as we hop right in, remember that options carry a high level of risk, not suitable for all investors. When we talk about information, this webcast, the information we talk about here, is provided for general informational purposes only, should not be considered individualized recommendations. Some of the things we talk about, you might say, I'd never consider anything like that. That's fine. So that's why we kind of show an array of strategies, and you pick what you would consider to practice in your paper money account. And that's very key here. You could watch something, but practicing it in the paper money account, it's different. So practice the strategies that you might consider for yourself. Also remember that the paper money account that we use, it's a software application. And we use it for an educational purpose to learn. And also remember that when we talk about examples, investing involves risk. And today, what we're really going to be talking about is kind of the market in some cases neutral-ish, okay? I think there's more stocks than sectors and indexes that look bullish. So it looks like investors are kind of doing some stock picking. Every Thursday we ask the question. By the way, you should ask this every day. Where are those trends? Where is the relative strength? But as we look at the markets here today, I want you to kind of notice individual stocks look stronger trending than sectors and indexes. So that's where the investor, this is kind of more of a bottom-up market right here, where we're kind of seeing stocks leading sectors and indexes. Now, just real quick as we get started, there was a question that came up. We'll look at the indexes first, sectors, and then we'll talk about some individual stocks. On our examples, we will also bring up past trades, which we need to, and also some new examples. And I'm going to kind of talk to you about kind of sometimes what can happen in the portfolio when the market goes to the upside. That's good, but also maybe something that needs to be managed. Now, first off, there was a question regarding what are the whole moving averages, like the labels, okay? So on this chart, and I'm going to share this chart with everyone, just so if you don't have it, but I want to go to a question and we could just kind of discuss it just real quick right up front. So what you're going to notice is the chart link that I sent to you is we call it the package of charts. Sometimes we don't want everything on one chart. I've seen that before. It gives me anxiety. So this is kind of like tools in your toolbox. I just want to use certain tools or charts at a certain time. Example again, we're just looking at, give me two different moving averages, price and a MACD. That's it. I don't need everything else. So what you're now going to notice is the R stands for red, okay, red line on the moving average. And the G stands for the green line on the moving average. Now, a lot of people will say comments like, well, I'm not very good about entry. Well, I don't know why you'd say that now, if you ever did. So this is really kind of showing if someone says, look, I struggle with entries and exits, this is really telling us timing. So if someone said, look, I went back on the last couple trades and I got out on R1, red moving average, day number 1, R2, red moving average, day number 2, red moving average, day number 3, and so on to 4 to 5 and 6. The way I would think about this, if you went and looked at your past 10 trades and you actually said, James, I did 10 trades, 10 recent exits in the paper money account, and I'm averaging getting out on day 7 or 8. What does that tell us? It tells us you're late, okay? You're late, 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 and more late. And so what that means is if you had any unrealized gains, you gave a lot of it back. So that's not really, it's maybe not a tool set, it's just paying attention, okay? And I think the biggest thing about success is focusing, okay? And the other question with that is focus on what? focus on using the tools for timing. So that when you're actually trying to be consistent and disciplined, you know what you're being disciplined to. Now, you might be saying, well, how do I put those on there? Well, they're on there. If we actually go to the shared whole moving average cloud, we click on the little settings gear, not that one. Let me actually see right there if that actually has the label. And actually, excuse me, it's right, the shared whole moving average labels. So I'm on the first chart, and you'll see that right there, right there. And it's whole label. They're called bubbles, okay, little, and that just like a little cloud, right there. And you don't need to know the name, but I'm just saying when you look at this and say, which one do I click on? How do I turn them off and on? Well, if I click on that little check, that little settings gear right there, it will say show bubbles. No, I can just turn them on, show bubbles, yes. And that's how you turn them on or off. So if I go back and actually do that, you're now going to see that I've done it twice now. So if I take them off, and you're going to see right there. Okay, so that's how we're turning them on and off. And also, the other place that actually has that drop down is the 10 hole label. You might also have that. So you could turn them on there. Okay, show bubbles, yes. Okay, or no. If I do that, put that, they're gone now. So those are two places where you could kind of turn them on and off. Okay, so we're going to use that here today. Okay, so if you feel like, my gosh, my timing is absolutely horrible, I think a lot of investors would say, use the label counter that's physically on the chart. But the other way you could actually look at that is if you went to the Market Watch. Another way you could see it in a list is actually taking a look at the whole counter. I like both. I think there's reasons to look at both. So example given, if someone said, James, I'm looking to, let's say, get in gold, example given, we'll talk about these. Let's say gold. Well, this has only been 5 days into the green moving average. This has been 4 days into the green moving average. If we actually said what's actually giving us day one or day two or day one or day one again, it's the equity indices, okay? So whether you want it in a list form, the 10HC, that is, so when you have the green background, that's signifying the green moving average. The number in the box is the number of days, okay? So if we actually said red, if their box was red, that's a red moving average. Now, scripts are great. 100% accurate? No. That's why you want to verify them, okay? And have an understanding is this telling me what I think it's telling me, and I'm checking to see the consistency, okay? All right, good. I'm glad we could hit that. Now, speaking of that, let's actually go back. So remember when the VIX popped, right? Last Friday, we said, hey, when the VIX actually pops to the upside, you know, we could actually have lower lows on the market, broken support on the market. We have a lower low and a little lower high. Now, the good thing is the market has actually gotten down, it's gotten above where we gapped down from. So the equity market is showing some resiliency in pushing back to the upside. Good, okay? Now, sometimes what I said on Monday is it's probably pretty likely that we might get some consolidation on the indexes, sectors, where they've actually had a very strong push. Now, when we say that, that does not mean that all stocks are just going to go sideways in a consolidation range, perhaps. That's not true, as you will see. So when we talk about the indexes, if we were saying, I'm going to buy the indexes here, what's the shorter term outlook? We might say kind of a little bit more neutral, a range bound area. And sometimes we need range bound to create higher support levels over time. Now, when you actually look at let's say the NASDAQ, same thing. But the biggest thing about the NASDAQ is we actually got above where the gap down was. And we talked about gap downs the other day. That's going to be a big topic here today. This is where we gap down from. This is where we gap down to. And what you're now going to notice is we kept talking about last Monday. If we actually, the resistance is the gap down open price. If it's a red candle, the very next day, it actually pops to the upside. That's a break of resistance. Now we're trying to fill in the gap. And we've actually seen now the NASDAQ use what as potential support? Calling all technicians. Well, so number one is based on last Monday's class, the gap down, the red candle, that becomes the open of that, becomes the resistance. Okay. So when is it turning? Well, if you can close above that, it's reversing. It's 8-4. It's showing signs of reversal. Good. Filling in the gap. 2 days after that, using the 10-period moving average as support. Okay. And now getting a little push. The NASDAQ leading all other indices. Okay. So, by the way, is that a bad sign? And the bulls say, don't ask a stupid question. And that kind of was not the greatest question, right? If the NASDAQ is leading, that is kind of really showing us that bulls want a piece of that potential upside. And I repeat, piece. Now, I want to kind of talk about just real quick. Let's talk about, if I were to ask you, let's say stocks that were NASDAQ based, what would you tell me? Now, I'm thinking of two of them, okay? Now, I want to kind of look at this right here and said, is there any stock that gapped down as of lately that is showing signs of reversing? Do you know any? Whatever you tell me, I ain't going to tell anyone, okay? Well, if we kind of said NASDAQ, now, by the way, if I went into Market Watch, we went right into Visualize, and I said, look, let's say we just looked at this and said, are there any of these big stocks, these big squares, rectangles, etc., that are showing signs of reversal lately after gapping down? Well, yeah, so Jack actually nails it. Jack, you get 20 extra points for you today, okay? Amazon. Now, the biggest thing is what you're going to notice is where's the gap down? Well, it should be pretty easy to see. It's a big, massive hole in the chart. and this one was a pretty good one. Where did it gap down to? It gapped down to right there. The open of the red candle becomes a level of resistance. Now, yesterday, I was at the airport. My son came home from Ecuador. And trust me, it doesn't mean that I was just sitting there the whole time. Thank heavens for Thinkorswim Mobile, okay? And there was a lot of times to actually look at some charts along the way. It wasn't like I was the only one at the airport. But if you take a look at this, you're going to see that we poked above. So we're now thinking that could 217 be a level of resistance? And for example, could, let's say, that flip into a potential support? That's the idea, right? So a monster candle yesterday, intraday high here today. And now we're thinking, hey, how far are we actually really off this moving average? Now, I know a lot of times we look at this, it's too far off. I want it to come back. And all of a sudden you measure it out and it's not as far as you think, okay? We're talking about within 1.5-ish% of, let's say, that potential support level. Now, I want to go to this chart. I want to kind of talk about the two portfolios for just a moment. So when you look at the portfolios, it's at 113-ish thousand. I mean, if we just round up $100. And you look at the cash, 58,000. Do you see anything that might kind of stand out? What about the other account, just real quick? So you see anything, there's the balance, there's the cash. What do you notice? You see anything that stands out, anything that might be wrong? 35,000 on that account, and the cash is 35,000. Anything that stands out? So what happens is when the market goes to the upside, there's probably a lot of opportunities to take profits. Well, you take profits, and then the cash goes back into the account, and so you're kind of cash rich. The problem with that is if the market keeps going to the upside, you're like, wow, I don't have that many positions. So like as someone who's like buying and selling cars, if I sell a car, it now leaves an empty spot on the lot. And now the owner of the car lot says, I need to go out there and try to buy a new position / car and try to sell that one and repeat the process. Now, in this case, what I want to do is we have Amazon right there. That is literally with 8 days remaining, noted, okay? And I'm going to go back to the IRA account for just a second. And I see that also right there. It's down a little bit. This has 43 days left. This is with one contract. Now, what I'm going to do is sometimes, and that's initially been down a little bit, but I want to go back. We'll come back to Hood in just a moment. That's going to be the third stock we look at. If we look at, let's say, Amazon, what we're going to do is we're going to add on to the position. I'm going to go back to the trade tab, okay, and type in Amazon. Now, what I'm going to do with Amazon is I'm going to come back, let's say the position we have right here, we can see that, okay? Now, if we did a short put vertical, we know that that is more of a probability-based trade. The reward to risk, it's not as high. If I come over here to the long call vertical side, if I did that, well, that would actually kind of be more of a one-to-one reward risk. Well, if I pick, let's say the 220, right click on that ask price, go buy, go to vertical. And what you're now going to see is, let's say we did even like a 220, 230 call vertical. Now, just because they have the strikes doesn't mean it's liquid. We want to verify with our own eyes in the paper money count. So on the 220 strike, we got a 10-cent bid-ask spread. Okay, like to see something narrower than 20. It is 10. What's the open interest? 31,000. Volume today, 2,100 contracts. What about the 230? 3,900 contracts, almost 4,000, 17,000. How wide's the bid-ask spread? A nickel. So if we did a long call vertical, which trade has more potential upside? It's the long call vertical. The debit is about 490-ish, which means that the max gain, given the vertical, it's about $510. So we're trying to kind of, you could think of this as maybe perhaps dollar cost averaging. We're just layering on strategies that are similar, but we're just trying to kind of put on a little bit different timing. Now, notice the commission as well, send the order. Now, that was the first one. Now, last Monday, we talked about gap downs. We said on earnings, you can get gap ups or gap downs. And sometimes these reversals can be quick, back to the upside, like the whole gap down never happened. Let's kind of walk through and see how Amazon does over the next couple of days in the paper money count. Second trade we want to talk about that also had earnings, the kind of along the same theme. Now, the one thing what you're going to notice on Apple, which was also in the comments, thank you for that, did Apple gap down? It did not gap down. On its earnings day, it gapped to the upside, and then it fell quickly. I'm going to use the same idea, though. On the post the earnings day, that was the first day after earnings, and it sells off aggressively. Now, what question do you think the investor might want to ask? Well, when the stock actually falls down like that, you got to ask the question, why on earth would someone be buying on fresh, new lows? Why would you be buying on fresh, new lows? Well, I could have had some news that changed it. Yeah. Could have had some institutions that were waiting to buy it, or retail investors that are going to look to buy it. Sure. Now, what you're now going to notice is if we go back to where it went yesterday, this was hard not to see, okay? If you take a look at, let's say, where the 210, the resistance was, we traded and closed above it. Now, I know some of you are volume people. Some of you kind of say, I like looking at price, but I want to see volume. So if you said, hey, I'm a volume person, let's pull this up for just a second. And if we look at the volume average, we'll add that. We're looking at the 50-day. I'm going to change it to 21, so it's like 1 month of trading. We're going to look at the stock and option volume. And if we look at the volume yesterday, okay, so on the sell down day, earnings, the day after earnings, the volume was actually pretty high. We could see that. Second, what you're going to now notice is if you look at the volume yesterday, that was even higher than the earnings day. Now, this is where people say, yeah, but. Okay, well, I mean, that's what technical analysis is. There's not a whole lot of yeah, buts, okay? You're really just looking at the price action. Now, let's go back to the trade tab for just a sec. What do you think we want to see with the trade tab? Well, first off, let's kind of go back to this just real quick. Let's go back, if I can. Let's go back to analyze for just a second. Let's go back to think back. Now, if we go back to think back, what I'm really getting at here is I want to go look at, let's say, the volume in the open interest as of yesterday. So if I actually pull this up, I just want to kind of see what this was. So if we're on the 7th, I want to see the activity on the 6th, okay? Now, if we take a look at this, I want you to kind of notice this. If we do this, we want to go to the 6, and what I want to do is open up the number of strikes. Now, if we go and take a look at this, we go to volume open interest. You're now going to see that if we look at the open interest, now remember, what is open interest? The open interest is the number of contracts that are open and unexercised. So this is potential future liquidity, okay? If we look at the volume, these are the number of contracts bought and or sold. They're not netted off. So if the investor goes out there and buys 100 contracts, that's 100. If you sell 100 contracts, well, that would be 100 plus 100 is 200. So it's just looking at the number of contracts bought and or sold. They are not offset. The higher the volume, the more activity. And so what the investor is really looking for is what's the volume in comparison to the open interest. And the higher the percentage, the more there's starting to kind of be like a little, some activity here on not only the stock volume, but also the options. Some people trade the stock, other people trade the options, which is actually going to give them the potential right to buy the shares if they did a long call, or the potential obligation to, let's say, buy the shares at the strike price if they sold the put. Now, what you're going to notice is that's 50% of the open interest. That's over 100% of the open interest. This is actually 20-ish, about 30% of the open interest. That's about 75%, and so on. Now, what the investor likes to see is it's not just on one strike, but it's smothered all over the place on each one of the strikes. And not just on the calls. You want to see them actually kind of layered on the put strikes as well. Shows more activity. Now, what you're now going to notice, if we look at the September's, it's not just one expiration. It might be multiple expirations. And that just kind of shows that a lot of people might be hitting this, not just some short-term pop, but they actually might be saying, look, I think I'd like to kind of take this from different angles, different strikes, different expirations, and so on. And we saw that yesterday. Now, if we follow through on that here today and said, well, let's go back to the August here, do we see any of that? Mine, hello, doink. Now, if we take a look at this, these 215s, that's 50% of the open interest. That's almost 100%. That's 2 times. That's 65%. That's over 100%, and so on and so on. Now, you can do what you want, okay? I'm going to ask you to be very careful on thinking that every day you got to create some new watch lists, because a lot of the stocks, Apple, Nvidia, Microsoft, Amazon, Google's, Meta's, the whole 9 yards, Palantir, the whole 9 yards, these stocks, a lot of these just tend to trend. You could probably make a list of 35 stocks and say, this is my Dow 30. These are your 35 stocks-ish that you look at all the time that you probably could find some trends on. Now, I say that because I felt like I wasted so much time in creating a watch list, but never really buying anything a lot of times. I was making a professional watch list, but a lot of times those trends are right in front of your face. Mine too. And the investor is not trading what they see. They're kind of like aim, 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 and they never fire. Now, I say that because I know that, okay? So that's why, now when we take a look at the position, let's go back to this and look and see, could the investor maybe try to trade the upside here, thinking might it try to go higher? Now, the next level of resistance we see on the chart, if I go back to the price, that sideways S, show prices percentage, no thank you. Give me the dollar amount, please. We're getting above the area. Now, what's the R word that we're looking for? What's that R word? Now, what you're going to notice is, if I kind of draw this touching the little peaks, I said, please, what's the R word that we're looking for here? Resistance. Now, you got to say it, not resist, resistance. Okay? Now, if you take a look at this, the next level of resistance is really 223. Above that, maybe if it were to get there, let's say 230 or so. So the biggest thing about this is those are kind of the next levels. And if we don't know if it's going to go up, we don't know the future at all. I don't even know what's going to happen in an hour. If we take a look at this, we got 247. Those are the markers. So a lot of people say, James, I want to see a breakout, but I also at the same time want to see the volume behind that, okay? Now, if I zoom in a little bit, let's not kind of just act like we don't see it. So the 10-period moving average, there's number one. Let's put the labels on, and we will in just a sec. On the 20-period moving average, there's day number one for that. And what do we actually notice right here? There's your pinch and or crossover. I do not want to act like, oh, this is a breakout and the moving averages don't matter. Well, they do. It's just kind of showing us what we would think they would show us. If it breaks out, of course the moving averages will be green. Duh. Okay, but I would say to myself. Now, if we take a look at this, I want you to kind of pay attention here. If I click on the settings here, I apologize for my dog Jackson here today. We're going to go to where it says show bubbles, and I'm going to click on, let's say, I'm going to say, not where I said no, I'm going to go change it to where it says yes. Now, if I do that right there, I'm going to click on that, click on apply, and then okay. So now all of a sudden, if you said, James, I can't see on the chart where there is that first day, there it is. So here's the thing. The moral of the story is we're not watching. That's the truth. And it's just the truth, not watching. Because a lot of us, we're looking at all kinds of different stuff all the time, and we're not looking at the main 35 stocks that probably make a big difference whether the market goes up or down. Limit what you're looking at, okay? So every day I look at the Dow 30, NASDAQ 100, S&P 100. I look at every one of those stocks on a daily basis. When you do it day after day after day after day after day after day, it's not going to take you more than 10 minutes. I like to physically put my eyeballs on those charts. What happens is you start to remember what those charts look like, and there is value in actually looking at those charts. I'm not against list, but I want to physically put my eyes on those because it's kind of giving you some practice of looking at technical analysis. Now, on that trade, what we're going to do here is we're going to come to the Apple position. We're going to take a long call vertical perspective. Now, the long call vertical, it's fine in the fact that there's a max gain, max loss. The con of that trade, there's a max gain. The pro about the trade, there's a max loss. So if this stock actually goes up to 240, someone that does a long call vertical, they might say, James, I don't want, for example, a cap gain strategy, but many other investors say, James, I'd rather have something, okay, than potentially nothing. So, and I'm saying that comment not just based on Apple. You just have to understand that, in a vertical type trade, there's a cap. And some people are okay with that cap, okay? Now, some person said to me one time when I was teaching an in-person event, they said, I never do anything with a cap. I said, where do you work? He tells me where he works. I said, well, do you get paid a salary, bonus, things like that? Yeah, okay. So no matter what you do for the year, it's capped. He goes, I've never looked at it like that. And then the wife said to him, and see, that's what I've been telling him. I've been telling him he should go do something where there's not a cap. I said, hey, look, my conversation was not to have a marital conflict here. We were just discussing strategy and similarities. Now, what I'm going to do on this trade is we're going to take the 215, the 225. This is the September. We're going to send the order, okay? So that's trade number one was Amazon. Trade number two was Apple. Now remember, did we have to make some special watch list? No, okay? If we looked at some of the just Dow 30, those are both in the Dow 30. Speaking of Dow 30, if I went back to that for just a moment, if I went to Market Watch, if I went to quotes, and I said, look, just hit me with the Dow 30, go to the public list, and let's go look at the Dow Jones Industrial. Now this, if you take a, when I look at this list, one of the things I like to look at first is this column, okay, which is, well, let me take that back. If I'm looking at this on like today, it's usually ranked by percentage change, okay, that's what it's ranked, because you're trying to really see which stocks are up today, Apple being the top. Now, if I look at, let's say, the second column, if I said, I wonder which stocks might be showing some, let's say, strong bull flag candidates making polls perhaps, meaning in the last 5 days, they've been ascending, or which ones have been ascending the most. If I click on the percent, we actually now see that the stock that's actually on the highest percent for the week, it's SHW. And we also see Walmart and actually Apple. Now, we talked about watching Walmart. That broke out yesterday. We saw it, okay? That was kind of setting up there for a little bit. Apple's number 3. Now, if you said, James, I'm trying to find something that has a trend, not just what, a 1 week pop, okay? Well, if I go back to the 1 month, these are some stocks that are really showing a trend, okay? So that's, each column kind of has a different purpose. What is moving today? Percent change. What is actually maybe starting to make a bull flag pull? 1 week percent. I'm looking for a trend. 1 month. Okay. And that's the purpose of the different columns. Now, if we kind of said, when we look at, let's say, the trend column, we are trying to really see which stocks have what type of trends and what is the sentiment. Well, if I looked at let's say the Dow 30 stocks, and I said, hey, look, let's imagine this whole list. This gives me goosebumps when I think about this. Have you ever seen the whole list like green? Okay, it's amazing. If that whole list was trend 3, you pretty much got all those stocks confirmed. Okay, script's not guaranteed for accuracy, but you got those stocks above the 10-day moving average and the 30-period moving average. It's unbelievable. Now flip that. What if the whole thing was red? And I've seen that too. It's not as remarkable. No goosebumps. Okay, if we take a look at that, if we were all in red, that is showing a sentiment. That's also showing the prices below both moving averages. So when we look at this chart, we're kind of seeing that half of the Dow list is in trend 3. It's probably about half, maybe 40% or so. Now, when we said which stocks are kind of showing the relative strength, we could actually now take that and say which ones are showing relative strength over multiple different time periods. One of the stocks that's kind of showing that right now is Cisco, okay? Little push into that. We're also seeing kind of some pushes into some other areas as well. Apple's been pretty solid over the last couple of weeks. NVIDIA's been solid. Chevron turned back up. That's how we're actually using this. The RS, these are the stock performances relative to the S&P performance over that duration of time, whatever column you're using. We're looking at all the columns. We're seeing what has the trend been of relative strength over time. Now, I want to go back to so those are kind of how, I'm mentally using those tools. There's values in looking at those charts, but there's values in also looking at the columns, but just like a tool in a toolbox, what do I use it for? That's how I'm using it. That's the purpose of the tool. You can use whatever tools you want. You pick and choose what you want in your toolbox. Now, what I'm going to do is I want to go back to Hood for just a moment. Now, this one kind of came out a little bit because when I pulled up Hood, and let me kind of show this, let's go back, and I think there was a mistake, okay? So if I go back to the IRA, we'll go back to the margin, Hood, those shares are still there. Now, what you're now going to notice is when we take a look at Hood, you're going to see that on the trend daily, it's showing trend 3. On the trend weekly chart, you're going to see that it's really showing trend 3. My gosh, I think many investors who are bullish, that's what they want. Now, if I said, James, my timing has been horrible, I don't know why, because the tools are there, okay? It really now just comes down to the person and then letting the trades play out and managing risk. Not all trades are going to be positive. Okay. Now, by the way, you could get it on the first or second day and the trade fails. Okay. But if it does work, typically the investor, many of them are trying to buy closer to where the signal actually came in at, so that way it's closer to support. There's still risk, but there might be less risk. Okay. But there is still risk. Now we have a green moving average, and it's been green for 2 days, and the 20-period moving average has been green for 2 days. Now, the reason why I said this is probably a mistake and we didn't see it, if I go back to this chart, something kind of tells me something might have not quite worked, okay? And so when we go to the third chart in, what we're doing is we're evaluating stops, okay? So on this chart, let's go to the fourth chart in, excuse me. There it is, okay? And what you're now going to notice is when this chart was going to the upside, okay, here it is, and our stop was sitting right there. Now remember, if you said, James, I don't know what that white line is again, can you remember, tell me that? That's the 8-day low. The red line right there is a 10-day low, and the yellow line right there is a 20-day low. Everything looks fine on the chart, okay? Being disciplined and nice and tidy. So all of a sudden is kind of right on the 721 day, the stop was where it should have been if we're talking about using a set process using this methodology. Well, as I go up a little bit, what you're now going to notice is the white line is going up. Now, if we said we're moving up the stop based on that, the stop never moved. What does that tell us? Where in the heck was the investor? Okay, now I'll be honest, when I'm teaching on a class, not teaching on a class, I'm not looking at the paper money account. On our webcast, we like to go over many examples of trades, past trade examples, but a lot of times we don't look at all of them. That is just what it is. This one slipped through the cracks. And if you take a look at this, is the stop was never moved. That stop should have probably been at 91 all the way up to about $98. Are you with me? So the fact that the stop is there when the lines were up here says the stop was never adjusted. So all of a sudden, why I said this is a mistake is really on the date of 8/1 that could have been stopped out. Why? Well, because the price went down below the 8 or 10-day low. That's the day it should have triggered out. Now, if we said, hey, we got stopped out at about $99-ish, was there a potential gain on that? There should have been a little bit. If I go back and say, was there anything? Well, no, it would have been down about $5, would have lost about $120 down. The entry price was 104.34, and on the shares of the stock, that should have been down about $120. Now, here it is now. So let me show you where it is now. Stock has recovered up a little bit, but that's a mistake. So if we were going back and kind of auditing past trades, we would say something broke down in the process where the stop was never reviewed. And luckily, this has bounced back to the upside. But I think when you go forward, you would say, should have been stopped out. Okay. Now, I'm going to tell you right now, this is kind of the bad thing about stops. Sometimes you can just get an intraday price move down intraday or close down there for a day or two, and the stock pops right back to the upside. This is why some investors like to buy puts versus, let's say, set stops. However, not everyone has 100 shares. So some people with maybe less than 100 shares that don't like to use options, they might set stops, where others say, I have 100 shares, I don't mind to use options, I'm going to do puts. So it's kind of up to you and kind of what you want to do and how many shares you have. Now on Hood, I'm going to go back to, let's say, the daily chart, 3-year weekly chart. Now, if we actually go back and look at this, it's been a rope to the upside. Now, again, we're not trying to make investing extremely complex. We're really looking for kind of like crossovers. We're looking for the green shading, and we're trying not to overthink it, okay? Now, if we take a look at this, you're going to see that there's been some green shading, and we're kind of wondering, could this be like a little shorter term flag with a little push to the upside? Now, some of the things I was looking at yesterday, my family, they were shopping. I was in the parking lot in the air conditioning run car because it's hot in Utah, and I was pulling up a couple kind of news things and back on Toss Mobile. Now, here's the deal. In 401ks, there's trying to be a push that other investors that have 401ks that they can invest in that new asset class and private equity. Now, that's some news that's coming out. In other words, that it's not just like different type of funds or ETFs, stocks, etc., that 401k investees can get into other asset classes. Now, who are the companies that might take advantage of that if that were to broaden the funnel, if you will, as far as potential investors who might have 401k accounts and say, hey, look, I might be interested in maybe potentially other asset class to consider. Well, what we're going to do on this is we have the shares, and first thing we're going to do is let's kind of do it right. What I'm going to do is I'm going to move up the stop to where that is, where that should have been. I'm going to set the stop right at 98.95. The rule of thumb is that we're never, did I say never? Okay, never. We're never moving the stop down, okay? So we're kind of moving the stop to the highest intraday low that we had. That stop is going to be set at 98.94. Now, second trade what we're going to do, we're going to come back to this, go to the trade tab. And by the way, I think we had what, $58,000 worth of capital on this account? This one, let me double check this. And we're going to kind of, now doing verticals, it doesn't eat a lot of capital. Let's say you said, James, I'm an investor and I want to, let's say, try to buy the shares of Hood, the shares of stock. But let's say you said, James, I want to buy those shares and I might want to even do like a covered call. Now you might say, well, that's a foolish strategy. But then when I show you what the implied volatility is, you say, okay, take that back. I'm never going to say that again. Now, what you're going to now notice is when you look at Hood's implied volatility, that implied volatility, this is after earnings, it's only a 67%. When the implied volatility that's annualized is high, the premiums are high. And what you're now going to notice is that means that the investor can even sell higher up on the strikes or lower down on the table, if you will. This is just kind of like an arrival departure at the airport, right? The earlier flight's up top, the later flight's down low, same idea, okay? And what you're now going to notice is the investor, if they said, I'm going to sell the 120, that gives $10 of upside from the current price to 120. So that's about $10. Take $10, add the premium, $575. So that's what, $15.75 upside on a stock that is at 109.83. If that stock were called away, those shares assigned to the investor from now to expiration, that's a 14.3% return potential in 43 days. Now, I ain't got time for that. Too busy, okay? Well, other investors might say, you know what? I got some time on my hands. I might consider that in the paid money account. Let's practice this for just a second. The nice thing about a big premium as well is the bigger the premium, the lower the break even. The bad side, it's volatile. The stock can go up, quite a bit up and down and cause us to have some emotion. Now, what I'm going to do is I'm going to right click on this. We're going to go to buy and I'm going to go right to where it says covered stock. Now, how do I know that I did that right? Okay. Now, you ever ask that question? How do I know did I do this right? Right click on the bid or ask, click buy, and then covered stock. So when we do a covered call, underlying, I need the shares. So when I go down and look at this down below, you're going to see that's buy plus 100. So that looks like right. That's right. Sell one, the 120 call, 104 debit. Now what we're going to do is go single order. First triggers execute. What are we going to do? Well, we're going to set a stop. And what we're going to do is this is just saying first get in this. This is sequence. The first part of the sequence is get in. Second part of the sequence, get out. And we're going to right click on that and say create the opposite order. And on this, we're just going to change it from limit to a market, conditional order, same thing as usual, data GTC. And we're going to say, well, where could the stop be? Well, if we look at that, we're going to set that stop right around about 99.14-ish. And what we're going to do is we're going to pull that up. And to get to the conditional price, we're just going to move this over to 99.14. Okay? Now, if you feel like I'm not good with this above or at or above, at or below, don't worry. You can read down below. And it's saying down below, wait until the following condition is satisfied. Mark price of the security is less or equal to 99.14. If the stock price goes down to that level, it's going to exit the covered call. That means it's trying to buy the shares back buy the call back and then sell the shares. Okay. Now, what third trade we're going to do? Save that, confirm send. We're going to do a cover call on hood. Now, if that caps out to the upside, someone takes those shares at the strike price or all the way to expiration and gets assigned, not necessarily horrible. Okay. We're going to try to see if that can play itself out. Now, I'm out of my time here. I will come back later and do after the close at 4 p.m. Eastern. I want to thank Brent Morris in the chat for answering those questions in chat. Also, kind of give you a quick reminder, you could follow us right on YouTube. You could actually subscribe to the Trader Talks channel. You can also, for example, this is the link to the playlist, okay? And that's a link to the playlist of previous classes that we've done as well. If you say, James, where can I also find some more information about live webcast, the schedule, and also in-person events? This link right there will show that right there. Now, I want to thanks to Brent. Thanks to all of you. I'll see you back at 4 p.m. Eastern. Stay tuned for our next webcast coming up right at the top of the hour. And this has been the class on Trading the Trend. Thanks so much. Go out and practice in the paper money account. Take care. Bye-bye.